Okay, hello and welcome everybody. Today we're going to be covering the carry trade, an interesting strategy favored by banks and hedge funds, a strategy less well known among retail traders. Let's take a quick overview of what we're going to talk about today. We're going to cover what is the carry trade. We're going to talk about some key areas like interest rate differentials, the role of leverage, some strategies to look at involving the carry trade, the risks involved, and some of the technical languages used by brokers such as swaps and rollovers. As usual, I'd like to start out with a quote. Again, we've got another one from Jesse Livermore today, and he says, "Money is made by sitting, not trading." So I think this kind of resonates with the traders out there who recognize that very often the large money is made when people sit on their hands and are actually actively trading in the market, and that very much relates to the carry trade because it's a non-directional strategy. You make money whether the market is going up or down. You earn that interest. So let's get right into it. What is the carry trade? The carry trade is a very basic concept. It's based on simultaneously buying a high interest yielding currency and selling a lower yielding currency. So this allows the trader or investor to earn the difference in the interest rates between the two currencies, referred to as the interest rate differential. So to go back to basics for a minute, currencies are traded in pairs, so when you're buying one, you're simultaneously selling the other. So in the scenario of the carry trade, the purchase of the high yielding currency is being funded by the lower yielding currency. So one of the most attractive characteristics of the forex market is the degree of leverage that's available. So there's a lot more leverage available in the forex market than there is in the stock market, for example, where it's 2-to-1 leverage is normal, whereas in forex you have as much as 100-to-1 leverage or more that's often available. So without leverage, the carry trade is not that interesting. But when leverage is applied to the carry trade, the interest rates, payouts from the interest rate can be very substantial. So let's consider an example. So let's say you had an interest rate differential of 2%. That equates to 100% annual interest on an account that's leveraged at 50-to-1. So it's a pretty dramatic difference that the leverage makes. Of course, the good things always come with risk. So naturally, however, the carry trade comes with risk. There's a couple of major risks. If the exchange rate goes against you, you're going to lose money. And on top of that, if you're highly leveraged, that's going to make it even worse. And secondly, well, let's look at an example first. So for example, if you're long Australian dollar against the Japanese yen, with the hopes of profiting from the interest rate differential, you could easily lose much more than the interest payments if our JPY falls in price. And then the second major risk stems from the fact that interest rates are not static. So a reduction in the interest rate of the currency that you're holding, that is the currency that you bought, or a rise in the funding currency interest rate is going to change the interest rate differential out of your favor. It's going to make the interest rate differential is not going to be so good for you. So changes in interest rates, of course, can impact how profitable this trade can be. So let's look at a famous instance of the carry trade that you hear about a lot, that was used often by banks and hedge funds. So the yen carry trade was popular among banks and hedge funds from 2004 to 2008. And during this period, the yen weakened substantially against the dollar. So let's take a look at the chart, the monthly chart from 2004 to 2008. And you can see that if you were long dollar yen during that period, particularly up to sort of May of 2007, you would have done very nicely because you would have made a profit from being long dollar yen with the price going upwards, and you also would have made the nice interest rate differential, which was substantial back in those days because the US dollar had an interest rate of over 5%. So we can see what happened after going into towards 2008, that when the financial crisis of 2008 came around, the carry trade basically fell apart. But there was a nice period for the banks and hedge funds and the others who were involved in the carry trade at that time, where not only did they make this nice interest rate differential, but the price of dollar yen also went up, so they would have profited on that going up to, it looks like, about May of 2007 from this chart. So again, when the global financial crisis of 2008 struck, what happened was money flowed from riskier assets to safe havens such as the Japanese yen, the Swiss franc, gold, and so forth. And this caused the carry trade to fall apart. So what was very profitable for a nice little period there ceased to work out at all. So let's think about now what environments carry trades do well in. So carry trades tend to do well in a risk-on environment. In other words, they perform well in an atmosphere of relative stability where money flows into riskier, higher yielding assets. Conversely, when the carry trades not do well, they tend to perform poorly in times of uncertainty or in periods of risk off, as it's known, when investors are going to be more prone to buy low yielding, safe assets, low yielding, safe haven assets like the Japanese yen, like the Swiss franc, and so forth. And what happens as a result of this is that the price of the funding currencies is driven upwards. So that's not something you want if you're in a carry trade. Let's take a look at an example of a carry trade in today's market, or a potential carry trade in today's market. So looking at the dollar against the Mexican peso, here's an example of a potential carry trade pair. The peso currently has an interest rate, a really high interest rate of 7.75%, while the US dollar has an interest rate of 1.75%. So this represents really a rather large interest rate differential of 6%. It's a lot to work with. So how would you capitalize on this? So you would want to sell dollar against the Mexican peso, take a short position in that pair, and by doing that, you would earn 6%. But that comes with the substantial risk of being long an emerging market currency, the Mexican peso. So taking on the risk of the peso depreciating in value. So let's take a look at the dollar against the Mexican peso daily chart. This is looking back over the last couple of months. And we can see that this would have been, since about September, this would have been a very nice trade to take, a nice carry trade, because the value of the dollar went down, the value of the Mexican peso went up. So you saw an appreciation in the currency that you're long, the currency that you're holding. So in this scenario, since September, you would have been earning a nice high interest rate while also profiting on the exchange rate price going in your favor. So the price of the dollar against the Mexican peso falling. So a point that I wanted to bring up in terms of trying to select a carry trade and putting together a carry trade strategy is to look for what's going on in the market that you're looking to get into. So an important part of identifying a good carry trade is to look to join an uptrend in the currency that you're holding versus the funding currency. So in our example, we'd be looking for an uptrend in the Mexican peso versus the US dollar, which is what we had in the last couple of months, actually. This is by no means a recommendation to get into a short position in the dollar against the Mexican peso. It's just an example. And I would stress that it would be a very risky trade since it's an emerging market currency. And as we said earlier, that the money tends to flow out of riskier assets when in uncertain times. So if more uncertain times come around, you would expect to see money flowing out of the peso, which would not be good for your carry trade. Next up, let's just talk about some of the technical jargon relating to interest rates and brokerage firms. So you may have heard of rollover or swap rates. So the rollover rate is the net interest return on a currency position held overnight. So in the forex market, an investor borrows one currency in order to buy another. The interest paid or earned for holding the position overnight is called the rollover or the swap rate. So with Scandinavian capital markets, their swap rates are calculated each day at 5 p.m. Eastern Standard Time, and positions that remain open after 5 p.m. Eastern Standard Time are considered overnight positions. So with that, I would like to wrap it up, everyone. I want to thank you very much for joining us, and please feel free to contact me with any questions at dan.blystone@scandinavianmarkets.com. Thanks for joining us.